And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hub Day edition of the Real Investment Show. So a few things to get into this morning as we continue to get ready to wrap up the month. We have just this week and next week, month will be over, then we're into earnings season. Some interesting headlines out yesterday in particular as Wall Street is now putting a 6,000 price target on the market by year end. So we're right around 5720-ish right now on the index. So basically about 300 more points on the index between now and year end. Of course, that's because the market's done a lot better than what they thought the markets would do early this year. So the market has now surpassed all of the previous year price targets that these analysts put out early this year. We wrote an article about this, is that these analysts are wrong every year, one way or the other. And so here's another one. So now they're all having to go, well, we put a year-end price target of 5,500 on the index, and now it's a 57, so now it looks stupid. So now I've got to raise the price target to 6,000. So that's what's going on here. We're seeing a lot of upgrades to both earnings. Earnings estimates right now are expected to grow 18% by the end of next year. That will help support higher prices. Markets track earnings estimates as we go forward. So markets are getting a lot more exuberant about that outlook, and so markets continue to rally here. We'll talk about some technical stuff this morning when we talk about what you need to know before the bell. But interestingly enough, yesterday, while the market is very exuberant, and analysts are very exuberant, and investors are very exuberant, if we take a look at the American Association of Individual Investors or the National Association of Investment Managers, their confidence in stocks very high. They're very optimistic about stocks. Confidence for the rest of the economy, not so much. The Conference Board yesterday came out with their consumer confidence index that had a very sharp decline. It went from over 105. It was expected to come in at about 104. It fell to 97.8. So it was the biggest drop in consumer confidence since August of 2021, primarily focused on the lower income ranges. Of course, if you're, make $100,000 or more a year, you probably are doing okay for yourself, and everything seems to be all right now, right? Even those saw a decline in confidence a bit, but not nearly as much as those making under $50,000, which is basically they spend every dollar they make just to make ends meet. So they are not very confident about the economy and, more importantly, about their job prospects. So we're continuing to see concern about job safety and job security, and that's showing up in consumer confidence. But the interesting dichotomy here is that consumer confidence remains very weak, particularly about present situation. Their present situation fell sharply. Like, I don't feel good about anything right now. That fell sharply. That's not great going into election, by the way, if you're the incumbent. That's not what you want to see. But the other side of this is that they don't feel good about the economy, which means they're starting to cut back spending. That relates to slower economic demand, which we have been seeing, right? But that's economics, but that's where earnings come from. Yet, when we take a look at Wall Street, they're like, oh man, this will be great. We're going to grow earnings 18% next year. It's going to be fantastic. It's all good. I'm not saying we can't do that, but I'm just saying there's getting to be a larger and larger divergence between what's going on in the financial markets and what's going on in the rest of the world. And so, we'll see how this all works out into the end of the year, but this is where we start getting into a little bit of the technicals. We touched on this yesterday, talking about, gold as an example. But this also relates to stocks. Stocks are very, very overbought now, very deviated from long-term means, and that typically has an outcome. Let's talk a little bit about the market from a technical aspect here, short-term and longer-term. Here's what you need to know before the bell this morning. So let's talk about the market short-term. Got some bullish stuff that's going on. We've talked about this before. About this time last year, we were talking about what's called, it's a technical term called a cup and handle formation. And that typically is a bullish indicator if it resolves to the upside. And we had laid out some charts previously talking about this cup and handle pattern, and that it suggested markets were going to go higher into 2024, and that has certainly been the case this year. We're now seeing this once again. We have the cup handle formation, which is now complete because we now had a breakout to all-time highs. Now, what we need here is a successful retest of this pattern. So again, it's a bit early to say, oh yeah, it's definitely done, and now it's nothing but sunshine and rainbows from here on out. What we really need is a bit of a retest here, test this 20-day moving average, and then move higher. And that would help confirm that cup and handle pattern is complete. Now, historically, that suggests that markets should move higher. And again, a price target range for a cup and handle formation like this would put you around 59.30-ish, somewhere around there. So again, that's where that 6,000 number is coming from a technical basis. That's how you get to 6,000 from here is by the completion of this formation. But having said that, that doesn't mean you just go straight there either, because markets are getting very overbought here. We've had a very, very sharp run in stocks that's been nice. But consumers are getting, like I said, investors are getting very confident, bullish, kind of bullish allocations to stocks, et cetera, reaching very, very high levels. And again, that's just something that suggests that markets may struggle here a bit before they try to move higher into the end of the year. Now, having said that, though, there is a bigger concern here. And this is where, when we start talking about stocks from a longer term perspective, this is the one thing that we kind of want to pay attention to, because this is, now again, this is monthly analysis. So it's important to keep that into some type of context here. But looking back long term, whenever markets have been 3 standard deviations above long-term moving averages on a monthly basis. Now again, this is monthly. As we talked about yesterday, this moves very slowly, so it certainly doesn't mean that stocks can't go higher for several more months, because they certainly can. But when we have these very long extensions, and big deviations from the long-term moving averages, those have not resolved themselves kindly in that process. I mean, we go back and take a look as an example, when we had similar situations, it was in the dot-com crash. We saw it again in the financial crisis. Of course, we saw it at the beginning of 2022 with the Russia-Ukraine invasion. And now here we are very similarly, very elevated on the MACD, extremely overbought. We don't have a sell signal yet, so that's why there's nothing to worry about here at the moment. Markets are going to continue to work their way higher. But these long-term monthly extensions, these deviations are not sustainable long-term. Because again, just like everything, in order to have a moving average or whatever, you've got to trade both above and below that over a period of time. So a correction of some sort is eventually coming. But again, this is monthly. It could be 2 years from now before this occurs. But again, it's important to realize that markets are extremely deviated, which suggests that upside from here over the next year or two, however long it takes to get to a corrective process whenever it occurs, may be somewhat limited. So again, the ability to continue to move asset prices continually higher is going to become more challenging. These over the last couple of years, we've had some big 20% advances. It's been great. That is not abnormal, and particularly coming out of a correction like we did in 2022, in October of 2022. We were came down, test that long-term moving average, bounced off of that nicely. That was a very bullish pickup. That's why we talked about increasing allocation models, putting money to work in portfolios. It's been an excellent run from here, but we're now once again very deviated. So again, at some point, we're going to have to pull that back, reset the table for the next really good investing opportunity. It'll come, but again, we have to navigate that process when we get there. Anyway, just kind of a long-term aspect, short-term bullish, longer term, a bit more concerning picture. But again, that takes a very long time to get there, so it's not something you deal with today. But that's what you need to know before the bell this morning. When we come back from the break, we'll pick up a little bit on confidence, the markets, and a whole lot of other stuff. So don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. As we talked a little bit about yesterday, be sure and like the channel. We certainly help. Appreciate that. It helps kind of promote us with the Google algorithm so that our videos can get out there. So if you can just hit the like button, certainly would appreciate that. So when I get to this part of the set and I look at my computer, we have our YouTube channel up, so I can kind of keep a watch on you kind of monkeys in the chat. But there's a list of other videos that are right underneath that. They're being promoted by the Google algorithm because they have a lot of likes. Wink, wink, nudge, nudge. One of them is 8 charts that will change the way you see dating. And the chart shows that men's attractiveness peaks at about 35 years of age. Women's attractiveness peaks about 25 years of age. So after that, I guess it's just ugly people dating ugly people when you get to our age, right, Brent? I mean, if you're in your 60s, it's just ugly versus ugly. Nobody thinks you're attractive at 60 years of age.
Man, I am so glad I'm not in that pool.
It always amazes me when it's like I love my wife dearly, and we will. The only way we're separating, we've already told each other, one of us is dying. That's the only way that our marriage ends.
Death do you part.
Exactly. But it is interesting because I hear people in their late 50s, or I shouldn't say I hear people. We have clients that are in their late 50s and they're getting divorced for, it's just not fun anymore, whatever the reasons are, and they're getting divorced. And I'm like, where you gonna go?
Who you gonna call?
It ain't Tinder. I mean, swipe right, swipe right. I'll spit that out. Yeah, swipe left.
Yeah.
I just don't know where you go at that age. It's like at this point, you're just kind of on the Titanic waiting to hit the iceberg. So, I don't know. Anyway, I just accept my age for what it is and just live with it.
Comfortable with your mortality.
Exactly. All right. So talk a little bit about markets. It is interesting right now that because we're cutting rates, and this is the fascinating part about the markets at the moment, which is we're cutting rates. And historically, that's not good for stocks, right? So we go back and we talked a little bit about this yesterday, right? I mean, we have the chart from yesterday. In fact, let me just bring this up in case you missed it yesterday. But I posted this chart yesterday at realinvestmentadvice.com. It just shows the history of Fed rate cuts and crises, right? So every time the Fed's cutting rates, historically, that hasn't been great for stocks, and it hasn't been great for markets, and it's not been great for the economy. It's not been great for much of anything because generally the Fed's cutting rates in response to something that's happened, right? And maybe it wasn't a recession, right? It doesn't mean just because and this is kind of one of the fallacies of a lot of the narratives is like, well, the Fed's cutting rates and there's no sign of a recession. They don't have to cut rates in sign of a recession. They've cut rates to offset other stuff like savings and loan crises in continental Illinois and a whole variety of other issues that have come, Asian contagion and a whole long-term capital management, bond market crisis. So, they cut rates to offset risk somewhere in the markets. And again, it's hard to find what that risk is right now. But, the employment is fine. Bond market's doing fine. Credit spreads are extremely low. Doesn't seem to be any real stress anywhere. So Fed's cutting rates. Now, the dichotomy to this is that since 2009, everybody's all ramped up into the surging bull market that we've had because of consecutive rounds of quantitative easing and liquidity and support, zero interest rates. And so now the mentality about the stock market is, the Fed's cutting rates. That means, we go back to zero rates. That means, all this money will have to come back into stocks, and that's going to push stocks higher because that's what's worked over the last decade, right? Even though the Fed hiked rates in 2016, 2017, 2018, people kind of forget that preceded the recession in 2020. But see, we discount that because we go, well, that was just the pandemic. Nobody saw that coming. Well, markets saw something coming, right? We had the whole repo crisis going on. So maybe if it wasn't the pandemic, something else would have occurred, but we were heading towards some type of event back in 2018, 2019, 2020, just depending on how it showed itself up. So you can take that down now. So it's interesting, though, that now the markets are so exuberant, right? We've front run, as I said yesterday, we were talking about gold and stocks and utilities and real estate. Everything has been front running the rate cut. Now, normally those things would be selling off, and they did, right? Bonds did sell off, REITs did sell off, utilities had a terrible start, as the Feds were hiking rates, but they usually don't start performing well until after the Fed starts cutting rates, not well ahead of it. Now you have a lot of these asset classes that are extremely overbought, extremely extended, and now you have to kind of ask your questions. Well, where are you going to go to now, right? What happens next? But again, it's interesting because we have all this exuberance in the market, as I was saying before at the open, is that consumer confidence is not great. And there's a good bit of data that suggests that consumer confidence leads financial markets over time. So, this is kind of one of the big issues, is this dichotomy between the consumer, right? And again, basic math, where do earnings come from, right? They have to come from somewhere. Our earnings just don't show up. We can't just manufacture it. Well, we can through accounting gimmicks, but we can't technically, legally, we can't just manufacture earnings. So they have to come from economic activity. People going out, going to Home Depot, they buy stuff, and that creates earnings for Home Depot as an example. Then they pay their expenses, they pay their labor, they pay their employees, they pay their taxes, and then they get down to their profits, right, and earnings. But there seems to be a rather large disconnect between what we're doing in the markets versus what's actually happening in the overall economy. Here's a chart of the consumer confidence index yesterday. And I want you to take a look at this for just a second, right? Outside of the surge in confidence in 2021, so that surge in 2021, where did that surge in consumer confidence come from? Right? Stimulus checks. 2021, we're sending out stimulus checks. Everybody's got money to spend. You've got moratoriums on rent payments, moratoriums on student loan payments, moratoriums on everything, so nobody could get paid for anything, and everybody's getting money to spend. So you had this big surge in that confidence level, and that's what you would expect, right? I mean, I feel good. If I didn't get a check, but if somebody would have sent me a check, I would have felt good about getting a check, right? Since then, no more checks, no more confidence. And now confidence is back to levels that we saw in 2022, where the markets are declining and the economy is, we're talking about having a recession. You remember back in 2022, all the economists were like, oh, we're about to have a recession, blah, blah, blah. And confidence is back to those levels. In fact, as the chart shows you right here, is that the survey suggested that confidence was going to be lower at 104. It was previously 105.3, I think, was the exact number. Expected to come in at 104, came in at 98.7. That's a big drop. Where is that confidence drop coming from, right? So it's coming from the present situation. So how do you feel about your present situation, confidence-wise? Big drop, right? That's coming down to 124.3. That's not what you would normally expect to see in an environment where consumer confidence is important to overall economic growth and earnings. Because again, these are the people that are spending the money. This is where earnings are coming from. So again, this dichotomy between their current situation and expectations. So expectations, how do you think the economy is going to be 6 months from now? I think that'll be better, right? That came down too. People are not only You're going to have to hold on. I got to explain this chart for a second, so you don't have to leave it. No, that's fine. You can leave it there, but I'm going to have to explain what I'm in the process of explaining what makes up this chart, right? So I know, but I got it covered. I got 2 minutes. Just get the chart back up. So how do you feel a year from now? That's expectations. How do you feel right now? That's your present situation. If we look at a historical spread between the expectations, how do you feel about a year from now versus today? Whenever that has been extremely low and has turned up, and as it did yesterday, expectations fell and the present situation fell. We had a very sharp tick up in that spread between consumer expectations and current conditions. That historically only occurs in a recessionary environment. So again, the Fed is cutting rates. Normally the Fed cuts rates to offset the risk of a recession. The market doesn't see that right now, but consumers do. That's the interesting dichotomy that's going on in the markets right now. I'm going to write some more about that in this weekend's newsletter because this is pretty fascinating stuff. Well, if you're a nerd like me, it's fascinating, but for you, it's probably not. It's probably like, oh my gosh, it's so boring. But anyway, I'm going to write about this weekend's newsletter. It'll be on the website and on our new Substack channel. So again, if you are on Substack over there somewhere, be sure and follow me there at Lance Roberts on Substack. I appreciate it. Also, Twitter X at Lance Roberts. It's everywhere. I am everywhere. But my kids have, I'll tell you a funny story about my wife when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Never remodel a house. Learn my lesson. People warn me going in. They go, don't do this. It's like when I was growing up, my dad would say, don't do that because you're not going to like the consequences. And he was usually right more often than not.
Like plug the fork in the socket.
Yeah. I mean,
The Real Investment Show podcast.
the house has a pool in the backyard and they had AstroTurf for the backyard. So I really don't need a robotic lawnmower for about 2 square feet of grass.
At realinvestmentadvice.com.
No, you need another Roomba for the yard.
Apparently. Apparently.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So let's talk a little bit about Substack now and our Twitter feed and our YouTube channel. Please like the channel, as I said before. That helps. But it was funny, so this weekend, so the house that my wife and I have been remodeling sits right on Terry Hershey Park. We looked for a very, very long time. My wife and I, we love to both of us run. And we have 2 dogs, so we like to take our dogs out, for walks or runs, on the weekends in particular. And so we looked very long. It took us almost a year to find a house that was very close to a park. It didn't matter what park we were looking at. We just wanted to get very close to a park so we could go to the park and run and do those type of things. So anyway, so we remodeled this house. We sit right on the corner of Terry Hershey Park, and so we're out walking the dogs this weekend, and so she and I are talking. We're having this conversation. We're walking the dogs, and right in the middle of our conversation, a gentleman comes down the walkway, and he's running, right? So he's running down the pathway, and as he runs past us, he's like, "Hey, Lance," and just keeps right on going. And it was a drive-by shouting, right? And my wife looks at me. She stops, and she's right in the middle of talking, right? She just stops in mid-sentence. She goes, "Who was that?" I go, "I don't know." And she's like, "Why would strange people just say hi to you and know your name?" And it's like she starts inquiring, like, why are people saying my name as we're in the middle of just walking out in the middle of nowhere? What am I up to, right? What have I been doing? And I said, "Honey," I said, "I know you don't realize this, but there's a lot of people that listen to our radio show and watch our YouTube channel and follow me on Twitter and, read our I know you don't realize this, but there's quite a few people that know my face from the stuff that we do." And
You're
she's
kind
like,
of a big deal.
She doesn't think that. And she goes, and so she's looking at me. She's giving me one of those those kind of cocked eyebrows things, looking at me, and she's like, "I don't believe it." And I go, "Honey, I know you don't listen to it." She goes, "Look, let me tell you something about your show." And I go, "Okay, tell me something about my show." And she goes, "So I'm in my office the other day." She literally works directly upstairs. So we're on the 8th floor of a building here in Houston, and she works on the 9th floor. And actually, her office is directly above my office, and that's not by coincidence. It happened. Actually, it is totally by coincidence. It didn't happen on purpose. Her company moved here after we were here first, right? She moved here after. But anyway, and she goes, "I was in my office, and one of the gentlemen in my office came into my office and says that, I talked about you, and so he watched your YouTube channel for the first time. He says he didn't understand a thing you said." And I'm like, "I get that a lot." I said, "The show is about osmosis. You have to just turn it on in the background and go do what you're doing. And by osmosis, you will learn stuff about how the markets work over time. It doesn't make a lot of sense a lot of times, but again, there it is." So she's still not convinced that people know who I am. That's the bottom. She even came home from work yesterday. She said, "I'm still not convinced." So.
You'll have to be careful.
Yeah,
when you're
I
out
guess
and
so.
about.
But here, let me do this though. If you do see me out in public, don't do a run by. Just stop and say, "Hey, my name is so and so. I'd love to meet you." Shake your hand. Love to meet you. So feel free to stop, say hi for a sec. I'll introduce you to my wife. And then that way I can convince her that people actually do know me from the radio show.
That's worth the stop right there.
There you
Meeting
go.
Mrs. Roberts.
Exactly. So if you see me out in public, feel free to walk up, say hello. I told you the story about how that happened in Salt Lake City.
Yeah.
On our plane trip.
Yeah.
And see, she still doesn't get that one. So my kids were all impressed. Anyway.
We'll have to rerun that one.
Exactly. So I am a big deal at Red Robin, let me tell you.
Hey, baby.
I get private seating at Red Robin.
VIP.
Funny. All right. All good stuff. All right. So we were talking a little about consumer confidence. And again, that's, we kind of finished up that conversation. But again, just keep a watch on consumer confidence. What people are doing is very important to how the markets turn out. It may not. Now, again, this doesn't mean this. One of the mistakes that investors make all the time is that, I'll say something, and it's like, well, it didn't happen tomorrow, right? So, well, clearly you're wrong. And look, these things can take a very long time to mature. Like we were talking about on, earlier in the show today about the S&P 500. Looking at monthly moving averages and monthly deviations from those averages, those can take very, very long times to mature. They're going to mature. There is going to be a correction of significance like 2022, right? We were down about 20% in 2022. You're going to have a correction of significance at some point in the future. That is a guarantee. It doesn't mean tomorrow, right? It doesn't mean next week. It doesn't mean next month, not next quarter, not even next year. It could be 3 years from now, right? And as is always the case with investing, this is the biggest challenge for investors, period, timing. And this is the one thing that traps investors more often than not is the timing of moves. And this is why we talk about on a regular basis, just run a regular rebalancing risk management protocol in your portfolio, and you'll do a lot better over time. You'll sell stuff at highs, you'll buy stuff at lows. It'll work itself out over time, but run that regular rebalancing profile through your portfolio management system. So as you look at stocks that have huge gains, trim those back a bit. Stuff that's losing money, not working, not doing what it was supposed to do, trim those out, right? Pick the weeds. Doesn't mean that those were bad ideas, doesn't mean that you're stupid or you're an idiot. It doesn't mean that it just means that you bought something that didn't work, and that's okay. That happens to everybody, right? So don't get wrapped up, as we talked about yesterday, emotions. Very big deal with managing your portfolio. But again, these extensions are not sustainable long term. And the dichotomy we have between confidence and what's going on in the markets is going to play catch up at some point. Don't know when. So timing is, as I said, timing's the most crucial aspect to all of this. And there's a lot of big drivers for this, right? So, monetary policy is a big issue. Right? The Fed's still tightening their balance sheet, right? We're still going through quantitative tightening. We're still not back into quantitative easing yet. We didn't really see much about that in the last meeting, even though they cut rates. But Wall Street is getting very aggressive about expecting further rate cuts into next year. There's a large expectation of about another 200 basis points of rate cuts between now and the end of next year. That's a lot of rate cuts. And again, so let's go back to that 1995 comparison that everybody points to. The Fed cut twice in 95 and then didn't cut. And then they actually wound up raising rates later again towards 98. But what the market's saying is this is 1995, but we expect more aggressive rate cuts. Well, that doesn't really jive. There's no reason to cut rates much more aggressively if everything is okay, right? You're telling me that and here, just a good example, right? This morning on Wall Street Journal, right? Headline of Wall Street Journal. World economy on track for pickup as inflation is tamed. Why do I need to cut rates by 200 basis points if the world economy is on track for a pickup as inflation is tamed? Right? I cut rates to stimulate economic growth. But if I stimulate economic growth, I am going to increase inflation because I'm increasing demand. Now, again, don't jump off the hyperinflation train here, because that's not what we're talking about. I'm just saying is that if you increase economic growth from 2% to 2.5%, or from 2.5% to 3%, you're going to increase the pace of inflation to from 2 to 2.5, or 2.5 to 3%. You're going to increase inflation because why? You have more demand within the economy. Economic demand leads to higher prices. That's just how it works. So if I'm worried about inflation, if I'm the Fed and I'm worried about inflation and the economy is doing fine and already expecting a pickup in growth, and we're growing at 3% for the third quarter, by the way, which means inflation should be closer to 3%, then why would I cut rates by 200 basis points going into next year? Unless there's another problem somewhere else that we don't know about. The we being you and me, right? That's the big question. And it's a question we don't have an answer to because we don't know. But what we do know is there's a huge dichotomy between what's going on confidence-wise and what's going on in the markets, and we'll see with that. And also, as we talked about yesterday, oil prices are certainly sending some message here that we should be paying attention to. All right, quick break. We'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, so you guys in the chat, y'all got jokes this morning. Gotcha. Lance is so cheap, he drives around from party to party for free food and drinks. Yes. Extra napkins at the drive-thru. Save on paper towels. Yes. No, that's not me. Let me ask you a question. You in the chat, specifically. So, 1 is for yes, 2 is for no. If I spent one show out of the week answering your questions, would y'all behave? That's a 1. 2 would be no, I'm not going to behave. Would you behave and ask legit questions? Type 1 in the chat if that would be a yes, and I may dedicate a show out of our week to just answering your questions if you will behave. It's more like the mob rule in chat right now. I'm getting a lot of 2s. Right, I'm getting a lot of 2s right now that they will not behave in chat. So I guess I will not be spending a day answering questions in chat. So I thought I would try to help y'all out, let y'all have like a live Q&A where y'all could ask your questions, but apparently that's a no. Yeah, 1.5 does not count. So, all right. Well, I thought we'd give it a shot. Okay, a couple of things just to wrap up the show this morning. First of all, I did have a question in the chat talking about what technical indicators we were looking at. In the first part of the show, we were talking about the S&P 500 and talking about the monthly chart of the S&P 500. And the indicators that we were looking at were long-term moving averages. So it was when you're looking at long-term moving averages, right? So we're talking about moving averages that have some relevance to the price trend of the market. So if you want to kind of build this on your own, what you can do is pull up a monthly chart of the S&P, go to something like Stock Charts or FinViz, whatever you use personally for charting. Change the data to a monthly analysis. A good kind of trend over time, going back 25 years, just going back to 2000, a good example is the 36-month moving averages. So just set your moving average up for 36 months. What that gives you is kind of a running trend line. When prices are moving higher, that 36-month moving average kind of gives you a running trend. You can do 48 if you can do like a 36-month and a 48-month moving average. But again, so when you're thinking about this, right, this is 3 years and 4 years. So what have prices done over the last 3 years, right? So this is long term, and that's what I'm saying is like this is very slow to move, and it is not good for short-term portfolio management. You do not use monthly analysis for short-term portfolio management. It will not work, right? But it's good for telling you when things are excruciatingly expensive or depressingly cheap. And then you can overlay that with a moving average. So you put your moving average on your chart. You can put on a Bollinger Band, which kind of shows you your deviation from that 36-month moving average. And then, of course, use a monthly MACD, moving average convergence and divergence indicator. Those are the ones we were using earlier. Look, technical analysis is something that get very complicated very quickly. I don't get into the weeds on technical analysis. I keep my technical analysis pretty simplistic. A couple of moving averages, Bollinger Band, MACD, relative strength. Outside of that, the problem is that you can start adding on all these other technical indicators. Just there's so many of them that are out there. Money flow indexes and ADIs and all these other type of things. And the problem is the more indicators that you start adding to your analysis, this is my experience and my personal opinion. So you may or may not agree with me. You may not like the ones I use. You can use whatever technical indicators you want to use. But when doing technical analysis, I like simplistic is better because once you start getting more complicated and adding on more and more indicators, you start getting conflicting signals. And then you wind up with kind of information overload and paralysis because, well, this indicator says it's a buy, but this one over here says it's not. So what do? I just don't do anything. And that's one of the things that, it's easy to run into. It's kind of this, paralysis by analysis that occurs because you just have too much input coming in and you can't make a decision. So personally, the way we do it in our shop is we keep our technical analysis pretty simplistic. Again, we're not technical managers, right? We're not managing a portfolio based on just price analysis. We use price analysis to confirm our positions that we own on a fundamental basis. We like our companies fundamentally because of their earnings growth, because of their book values, whatever it is. But we use relative strength, momentum measures, those type of things to help determine when we should take profits, when we can add to those positions, when we should initiate a position, those type of things. And again, technicals aren't always correct. Fundamentals aren't always correct. I have stories of terrible outcomes on positions that I've bought on both sides of the fence, right? Technicals tell you everything's great, and then the stock just keeps going lower, right? Whatever it is. Happens. But that's where we come back to our basic rules of portfolio management. Pulling the weeds, trimming our vines, right? Taking our profits, fertilizing the soil, adding cash to the portfolio. So we go back to our basic management of our garden, right? We do much better over time. But technical analysis, again, it's something that nobody spends a lot of time on, right? Especially on the financial media, because that's not headline stuff. It's confusing. It's like, I don't understand it. And of course, it's often referred to by Wall Street as voodoo, right? Because it's just, too hard to explain. Just buy and hold. You'll be fine. Just, put your money in, let us collect a fee every year and you're good. But, again, if you're managing your own money, understanding some very basics about technical analysis can at least help you kind of navigate periods in time where uncertainty is elevated. And, this has been this way for the last couple of years, is that coming out of 2022, there's been a lot of uncertainty, right? We're really going back to the pandemic. Ever since the pandemic, there's just been a ton of uncertainty in the markets. Everybody's like, well, we've got debts and deficits. We have this, and there's so many headlines of, doom and gloom that are everywhere. And the next big bear market's coming. You better be, all in cash and whatever it is. And yet the markets have done exceptionally well. But the technicals, and again, we go back to, October of 2022. We go back to last year. In October, we've talked about, we're set up here for a rally, time to add money. In February, we're talking about, hey, time to take profits for a correction that's coming. Had one in April, May. Same way in June, July. Hey, we're going to have a 5 to 10% correction. Y'all were, saying like, you've been saying there's a 5 to 10% correction coming. It hasn't come yet. Well, and then it came in, August, right? Timing is always the problem, as we said earlier. But what the technicals were telling us is that there was risk, right? And technicals can tell you when that risk is also over. So, applying, and again, how you do it, everybody does technical analysis differently, right? There is no one way to do technical analysis for people because, the measures that we use are different than the measures that everybody else uses. We don't use standard measures in our technical analysis. So how we set our technical analysis up, the things that we do, is going to be different than we do it. And the way you do it is fine. You're not wrong, right? It's just different. And everybody approaches the analysis of price differently because all we're doing is, remember that market price is a reflection of psychology. That's it. So all technical analysis is the study of psychology. Literally. People go to therapy all the time. It's like, I need help with my psychology because I'm making bad decisions. And so you go to a therapist to get help on whatever bad decisions you're making, right? Same thing in the financial markets. Price is a reflection of psychology. All technical analysis is the understanding of that market psychology and helping define a picture around what that is happening psychologically. Right? Trying to diagnose the problem with the markets or the health of the market, however you want to put it, right? So all the technical analysis is just forming a visual picture around the psychology of the markets. And that's why it's so helpful in managing your portfolio, again, because fundamentals don't do that. As I said, we're fundamental investors, so we're buying stocks that are fundamentally good companies. But that doesn't necessarily tell us where the value of that company will be in 6 months or 9 months or a year or 2 years. We know that over the long term, buying fundamentals will pay off, right? If I buy a fundamentally strong company, I'm going to make money over the very long term, but that doesn't necessarily protect me in the short term because of market psychology. So just a way to think about it as you approach your portfolio, and if there's, maybe one day Mike and I will do a technical analysis 101 class here on the show or something. Anyway, get by the website. Be sure and like the channel. We appreciate it very much. As I said, that helps us kind of move up the Google algorithm. So the more that you like the channel as you watch the show, the better. Certainly helps us, and we do appreciate it. Be sure and follow me on Substack, at Lance Roberts as well. That's we're starting to post now as well. So just another outlet for you to get access to our information. It's all out there everywhere. And again, if you see me in the park, say hello, introduce yourself. Just don't run by. And have a great day. And we'll see you back here tomorrow with Michael Leibowitz. See you then.